For decades, entire families in the world's second largest economy put nearly half of everything they owned into a single asset. Not stocks, not retirement funds, apartments. 47% of the average household's net worth concentrated within four walls, because there was an unwritten truth that everyone accepted without question. Real estate always appreciates. Real estate is real wealth. Real estate never disappoints. That was the pact, and for a long time it worked. There's a collapse underway that did not begin with a financial crisis in the way the world has come to know them. No central bank failure, no currency crashing overnight, no precise moment when everything turned. It began when a belief became a dogma. A dogma became a pyramid scheme, and a pyramid scheme operated at a national scale for long enough that everyone inside it forgot it was a pyramid scheme. When the country's largest private developer entered liquidation, the official line was that the problem was contained. Then came the second largest, then the third. And what had appeared to be a series of isolated cases of mismanagement began to reveal something else entirely, that the entire structure had been built on the premise that prices would never fall, and that when they did, there was no plan B. Today, new real estate transactions across 70 cities are 53% below their 2021 peak. Resale prices have dropped more than 20%. The country's average inflation sat at zero over the past year, and more than 62% of urban depositors reported preferring to hold onto cash rather than spend or invest. The statistical portrait of a society that has lost confidence in the future. If you think this is a problem contained within China, just wait until you understand what happens to the rest of the world when the largest global consumer of industrial commodities stops building. How did a sector that once represented a quarter of the entire Chinese economy reach this point? What exactly broke the chain? And why have the government's measures failed to reverse the decline? What are the two paths forward? And what does each one mean for families, banks, local governments, and global markets? But this story doesn't begin with the collapse. It begins much earlier, with the belief that made it possible. For decades, China made the world believe it had discovered a magic formula for growth. Entire cities rose from nothing in just a few years. Roads cut through mountains that had stood for millennia. Skyscrapers appeared where rice paddies used to be. And behind all of it was an engine that most outsiders never quite understood. It wasn't just manufacturing. It wasn't just mass exports. It was the real estate market. At its peak, that single sector accounted for up to a quarter of the entire Chinese economy. 1/4 of the second largest economy on the planet. To put that in perspective, think of a single sector worth more than the entire economies of countries like Brazil or Russia, and that was just one slice of China. Chinese families got the message early. If you were making money in China, it didn't matter whether you were a factory worker, a government employee, or small business owner. There was an unspoken truth that everyone accepted without question. Keeping money in a bank account was naive. Stocks were a casino run by the government. But real estate was different. Real estate appreciated. Real estate was real wealth. It was security for old age, inheritance for the kids, the one asset that never seemed to let you down. And it wasn't a baseless belief. For years, property in China's major cities appreciated steadily. Those who bought early reaped impressive returns. Those who didn't were left behind. The narrative fed itself, and belief hardened into certainty. By 2022, nearly half of everything a Chinese family owned was tied up in real estate. 47% of an average household's net worth concentrated in four walls and a roof, not in diversified investments, not in robust retirement funds, in apartments. Now imagine what happens to an entire society when that belief becomes dogma. When buying property stops being a choice and becomes the only strategy that makes sense. An entire nation going all in on the same asset, without realizing those chips were everything they had. Developers saw the gold mine they were sitting on, and they went all in, no breaks. The model was simple, and for a long time it worked. A company would launch a project, sell the apartments before building them, use the buyer's money to pay for the land, start construction, and simultaneously launch the next project, which was also sold before it existed. The money from the second paid for the first. The third paid for the second. A chain that only worked as long as buyers kept coming and prices kept rising. It looked like growth. In practice, it was a pyramid scheme operating at a national scale. On top of all that, banks were lending generously. Local governments were selling land, enthusiastically, because that was their main source of revenue. And the central government watched GDP numbers climb and smiled. Everyone had a stake in keeping the game going. Everyone depended on it one way or another. Except the debt piling up on developers' balance sheets was reaching levels that no business model can sustain indefinitely. Companies worth billions on paper owed, in practice, far more than they could ever honor if the flow of new money stopped for a single quarter. The system only worked as long as money kept coming in. And deep down, everyone knew it. They just didn't want to be the first to say it out loud. In 2021, the Chinese government decided to act. It launched what became known as the Three Red Lines, a set of strict caps on developer debt ratios designed to keep the bubble from growing even larger before it burst on its own. The intention seemed reasonable: contain the excess before the market did it in an even more brutal and disorderly way. The problem was that the medicine was applied too fast to a patient that depended entirely on the daily dose. The credit keeping the entire system breathing dried up overnight. Developers operating with extreme leverage suddenly had no access to new loans, no cash to finish projects already underway, and a massive portfolio of pre-sold apartments to deliver, but no money to build them. The system that had seemed unshakable had found its breaking point. The spark had been thrown, and the barrel, as the world was about to find out, was far larger than anyone had been willing to admit out loud. When China Evergrande, once the country's largest private developer, entered liquidation, a lot of people were still trying to convince themselves the problem was contained. A badly managed company, an isolated case, an exception that proved the rule. Then Country Garden, another giant with projects spread across virtually the entire country, went into debt restructuring. Then came China Vanke, known for its large developments in the country's biggest cities, negotiating with creditors to delay payments it was supposed to honor. Credit analysts were blunt. Vanke would likely follow the same path as the others. When the biggest names started falling in sequence, it became impossible to keep up the narrative that the problem was contained. And the first domino to truly fall, the one nobody had properly accounted for, wasn't a developer. It was confidence. Think about the concrete situation of someone who had bought an apartment off plan. A family that scraped together years of savings, signed the contract, put down the deposit, and walked away expecting to get the keys on schedule. Now that same family wakes up every day reading news of developers collapsing in a cascade across the country. Projects frozen, construction sites abandoned with rusted scaffolding and exposed concrete. Buyers who paid and never got anything. The question that family is asking is one: is my apartment actually going to be delivered? And without a reliable answer to that question, the logical decision was to stop buying anything at all. The market felt the impact immediately and hard. Real estate investment plunged 17.2% in 2025. Property sales, measured by floor space, fell 8.7% in the same period. New home transactions in 70 cities dropped to 53% below their 2021 peak. These aren't numbers on a spreadsheet. They are empty buildings. Developers with no revenue. Construction workers with no jobs. Entire cities with concrete skeletons that nobody is going to finish anytime soon. And prices followed. New home prices accumulated a drop of nearly 12% since the July 2021 peak. Used homes, more than 20%. In December 2025 alone, new home prices fell 2.7% year over year, the fastest monthly decline in 5 consecutive months. Think about what that means in the life of an ordinary family. They bought an apartment in 2021, maybe the biggest investment they'd ever made. They pooled years of savings, maybe took out a loan, maybe asked their parents, their grandparents for help. And now that apartment is worth 20% less. The family's biggest asset has lost a significant chunk of its value. A lifetime of wealth, built brick by brick, is shrinking every single month, and it hasn't stopped. Then comes the spiral that turns a crisis into a collapse. The more prices fall, the less people want to buy. Who would buy today knowing the property will be worth less tomorrow? Fewer buyers means less revenue for developers. Less revenue means less ability to finish construction. Less finished construction means even less confidence. The cycle closes in on itself, each turn a little worse than the one before. That kind of dynamic has a perverse quality. It's nearly impossible to stop from the outside. There's no government decree that restores confidence. There's no interest rate low enough to convince a family to buy today an asset they believe will be worth less tomorrow. The market only stops falling when the participants themselves decide the bottom has been found. And in 2025, nobody was willing to make that bet. What happened to families was inevitable. People who watched half their net worth start evaporating don't go out spending. They tighten their belts. They hold on to what they can. And that is exactly what the data showed. More than 62% of China's urban depositors said they preferred saving money over spending or investing. That number has a name. It's called a collapse of confidence. And when an economy loses the confidence of its households, consumption drops, companies earn less, jobs become scarcer, and families have even more reason to hold on to their money. A vicious cycle that feeds on its own distrust. But the collapse didn't stop with families. It reached the banks. Developers going under don't pay their loans. Banks holding portfolios full of bad debt pull back on lending. And new credit to the private sector simply dried up. A senior executive at a developer in Shanghai laid it out without sugarcoating. His company tried to secure new loans, offered collateral, met all the formal requirements, and still got nothing. I don't see how private developers are going to survive, he said. And the worst part, even with the government signaling that banks should be lending more to the sector, the reality on the ground was something else entirely. The policies existed on paper. The credit wasn't reaching the market. The gap between rhetoric and practice revealed something the data alone can't capture. Distrust had taken root inside the financial system itself. Banks, however much they were encouraged, knew that lending to private developers in 2025 meant betting on assets that could turn to dust. When private credit shrinks like that, who suffers most is exactly who needed it most. The big, state-owned companies kept their access to financing. After all, the banks are also state-owned, and lending to the government is always safer than lending to the market. The private sector was left to fend for itself, and the private sector, where real innovation and genuine growth are supposed to happen, began suffocating quietly without any headline announcing it clearly. But the destruction didn't stop with the private sector. It hit the foundations of local government finances. For decades, China's provinces and municipalities had built a structural dependence on a single source of revenue, selling land to developers. While the real estate market was hot, that source was abundant. Governments sold land, pocketed the money, funded infrastructure, paid public workers. The machine ran. When the market crashed, that revenue vanished along with it. Land lease income fell 7.4% in 2025, deepening a decline that had already been choking local finances for years. Governments with empty coffers cut projects, delay services, accumulate their own debts, and create a crisis within the crisis, a public fiscal problem fueled by the private collapse. The central government didn't sit still. Between 2023 and 2026, Beijing launched a long sequence of measures, cut interest rates repeatedly, lifted home purchase restrictions in major cities, lowered minimum down payment requirements, created programs for developers to complete stalled projects, and even started buying unsold homes to convert them into affordable housing. None of it worked the way it was supposed to. The reason is hard but simple. All those measures were more sophisticated versions of the same tools that had already been tried. Rates had already been cut. Restrictions had already been eased. Banks had already been pushed to lend. The market had seen this entire playbook and hadn't responded. The approach was support without transformation, measures that cushioned the fall without touching the structures that caused it. There is a fundamental difference between slowing a fall and reversing one. The Chinese government was doing the first, while the market needed the second. And that difference, silent in official statements, was screaming in the numbers that came out month after month. The sector kept shrinking. Confidence kept falling. And the measures kept arriving, each round promising more than the previous one had delivered. And as the measures kept coming up short, the macroeconomic data began to reveal the true scale of the problem. China's inflation averaged 0 in 2025. 0. The GDP deflator, which measures price changes across the entire economy, not just retail, stayed negative for the second consecutive year. And growth, once seen as China's unquestionable fortress, was projected to slow to 4.5% in 2026. An economy where prices don't rise is an economy where companies hesitate to invest, families delay purchases, and debts become proportionally heavier with each month that passes. This has a name: deflation. And deflation is, for economists, one of the hardest scenarios to reverse. Not because low prices are bad in themselves, but because deflation creates the expectation that prices will keep falling. And when people expect everything to be cheaper tomorrow, they simply wait. They don't buy today. They don't invest today. They wait. And while they wait, the economy freezes. Japan went through this. It took decades to get out. And it still carries the scars. China is on the same path. And the real estate market is the epicenter of everything. The question had completely changed. It was no longer when will the sector recover. It was what China becomes when the engine that drove everything stops working. There are two possible paths ahead. Neither of them is painless. The first is a slow, drawn-out decline. Home prices are expected to fall another 4% in 2026, a steeper drop than previously forecast, before stabilizing at some point in 2027. It's the less dramatic scenario on the surface, but it carries a quiet pain that stretches on for years. Families watching their net worth keep eroding while waiting for a bottom that never seems to come, developers surviving on the edge, trying to honor commitments with minimal cash, and local governments trying to rebuild their finances on a foundation that no longer exists. For a genuine recovery to happen, several things would need to occur simultaneously: a robust package of economic policy support, real improvement in labor market conditions, and a significant reduction in the stock of unsold homes that simply isn't finding buyers. That process, by the most optimistic estimates, would still take several more years. The second path is the more dangerous one. If the slow adjustment goes off the rails, developers collapsing in a chain faster than the system can absorb, banks accumulating losses beyond what they can handle, local governments entering genuine fiscal collapse, the risk is a much wider financial crisis, with effects that spread far beyond the real estate sector and engulf the entire economy. The IMF named this risk plainly: A deeper than expected contraction in the property sector, combined with already high debt levels, could generate persistent weakness in domestic demand, entrenched deflation, and chronic reliance on exports to keep the economy afloat. With growth projected at 4.5% in 2026, the slowest pace in decades outside of the pandemic years. The margin to absorb additional shocks is getting thin. For the rest of the world, the consequences aren't abstract. China is the world's largest consumer of industrial commodities: steel, copper, aluminum, everything that feeds construction at scale. A China with a permanently depressed real estate sector means structurally lower demand for those materials. Commodity exporting countries would feel the direct impact. Emerging markets that depend on Chinese demand to grow would see their prospects narrow. But perhaps the deepest consequence isn't financial, it's structural. For decades, China's economic model rested on what seemed like an unbeatable equation. The state builds, families buy, properties appreciate, and the wealth generated funds more growth. That cycle is over. Real estate can no longer be the engine of the world's second largest economy. And that raises a question with no easy answer. What takes its place? The IMF and the World Bank arrive at the same conclusion by different routes. China needs to shift to a model driven by domestic consumption. Families need to spend more, and to spend more, they need to be less afraid of the future. But there's the knot that no short-term policy can untie on its own. China's household savings rate sits at 31% of disposable income, more than 5 times the average in wealthy countries. People save that much because they have that much to fear. A retirement that may not be enough, healthcare costs the public system doesn't fully cover, a job market that is increasingly unstable for young people, and now a property worth less than what they paid for it. Without a dramatically stronger social safety net, families will keep saving compulsively. And without household consumption, there is no sustainable growth. China knows this. And the necessary reforms are moving at a pace the market clearly considers insufficient. What's at stake isn't just one sector of the economy. It's the answer to a question China never had to face with real urgency until now. How do you grow when the engine that powered everything stops working? The biggest real estate collapse in history won't end with an explosion. It will end with a slow, painful, and probably inevitable transformation from an economy that built its wealth on concrete to one that still needs to figure out where it's going to build the next thing. And while that answer doesn't come, the entire world watches and waits.